All right, what's up, everybody? It's another week of What the F happened, and we're gonna dive in. Our boy Sam, SBF. Yeah, well, he was denied bail. The funny thing about that is, it's the largest Ponzi scheme in history. He was using investors' money to pay politicians. I wonder why. It's like he was up here and now he's all the way down here. But if he was denied bail, explain to me this: who was paying the bail? Last I heard, he had less than $100,000 left. Like, was his bail 50 grand for the largest Ponzi scheme in history? Nonetheless, it was denied. That's one thing we're going to talk about is crypto, FTX, Binance. We're going to talk about all the different cryptos and what that might mean for the future of crypto or the opportunity in crypto. I don't know. It could be one or the other. We're also going to talk a little bit about today's news that we will hear first thing this afternoon when Mr. Jerome Powell announces what their next move is for the Fed. Any guesses? It's kind of like double jeopardy. And Jerome Powell's increase will be, yes, is it going to be 50 basis points or 75? Well, if you talk to some people, they think it's going to be 50. The market's expecting 50 basis points, 0.5%, which a lot of people are going to cheer. When it comes out and they raise them 50 basis points, you're going to hear Wall Street cheer. Why? Because you got it right? Or because that's low? Neither. You're not going to get it right because 50 basis points is still a very big increase. Maybe it's not 75 basis points, but I think the Fed's target is 2%. And at 2%, we're at 7.1. The market's just rallied the other day. I laugh every time I see this shit. It rallied because it was anticipating 7.3 on the inflation, and it came in at 7.1. So it came in under 7.3, which means inflation is starting to come down. So we might come off the highs. I guess maybe that's room for a beer, maybe a Bud Light, but that isn't room for celebration. So why are we celebrating this when we have to get down to 2 and we're still at 7.1? And the Fed absolutely will continue to raise interest rates, maybe a little bit lower, but they're going to just do it longer. Lower and longer. Let's not just rip the Band-Aid off. Let's just take it off really slow. How do you guys like it? You like when you got a Band-Aid, you just like ripping it off really fast? Or do you like slowly tearing it off and letting that pain disperse over a lot of time? These are some of the things we're going to talk about today on What the F. We'll be right back. All right, we're back at it. It's Mr. Snaggy himself, my partner in crime. What's going on out there in Florida, Snaggy? You say it's raining a little bit.
Hey, good morning. Yeah, we got a little rain coming through, a bunch of rain coming through, which is an odd thing for this time of year. They weren't calling for it, but I guess it's better than a bunch of snow dumping down. Unless you have the ability to get out there on the mountain and do some snowboarding, then that's a beautiful thing, or even maybe building some snowmen with the kids. But nonetheless, holiday season's in full effect. Been going to lots of Christmas parties and was at a Christmas dinner last night and a lot more planned in the coming weeks. So hopefully everyone else is gearing up and ready to go for the holidays. But right now, today, we got a lot of news to hit. So let's get into it a little bit.
Well, quick welcome. Toxic on TikTok. What's up? What's up, Ocean888? What's up, Freddie? What's up, Drew? As everybody kind of starts coming on, you guys are probably at the gym. Maybe you're just getting to the office. Maybe you're just waking up. Doesn't matter. Let's get into it. Mr. Sam Bankman-Fried was denied bail, which kind of is funny to me because, he was juicing all of these politicians, all of these lobbyists, all the guys that have the ability to manipulate it, pull the strings. He was juicing them all with investors' money. They've proven that. He was using investors' money to pay politicians so that he got what he wanted. Now, are they going to keep him out of jail? That's the million or maybe even $1 billion, because in today's world, remember we used to say the $1 million question, and that was like the big thing. Now it's got to be like, that's the $1 trillion question or the $1 billion question. Is the dude going to jail? Because, he might be now, I don't know, denied bail. How much would bail be if you, so let me ask anyone this on TikTok, YouTube, Facebook, or Instagram, how much do you think bail should have been for him? If there was bail set, for the largest Ponzi in history, how much should bail be? Stephen, what do you think?
Yeah, it's a good question. I mean, keep in mind also he's in the Bahamas right now, so it's a Bahamian judge that denied him the bail. And, it says, bail on Tuesday, hours after U.S. prosecutors accused a 30-year-old of misappropriating billions of dollars and violating campaign laws in what has been described as one of America's biggest financial frauds. So in that case, I would say no bail is the right call. But if you were going to give it to him, I don't know. I mean, showing he doesn't really have any morals or ethics, and he's stolen billions of dollars from people. I don't know if there's an amount you could say is right.
I don't know. How about audience? What do you all think should be bail? No bail? Well, that they did. They denied him bail. But I'm just wondering, if they were to set bail, how much is right? How much is the right dollar amount for bail for something like the largest fraud in history? I mean, is it $1 million? Is it 5 million? Is it 50 grand? The reason I'm asking this question is, he was denied bail, but even if there was bail set, how's the dude going to pay for it? Answer me that. Last we heard, he had less than $100,000. Now, for his lifestyle, $100,000 lasts about 5 days. Now, maybe he's cut out the Starbucks, and maybe he's not getting dinners dropped off and the caviar and everything else. So maybe it gets him 10 to 15 days. But seriously, where's the money going to come from? Who's going to pay that? Because it probably isn't going to be anyone good paying that bail. But he was denied bail. And liberty or death, no. Unfortunately, we're not talking about Biden. We're talking about Sam Bankman-Fried. I'm sure there's many of you on here that would love to see Biden and his son be put in jail. But at this present point, I don't think that's going to happen, even though Elon found all those records on Twitter and released them to the public, showing all the stuff that was going on behind the scenes, all the hanky-panky, the bullshit that all of us, you and I, would literally be locked up for life if we did. But the politicians, the president and the president's dipshit son, nothing. It's just got suppressed. You can't even find it in the news right now. Good. Try to find Elon's, it's not even leaked. It's backed. All the stuff that happened at Twitter, he released all that. Those files were released, but you don't even hear about it. That's pretty funny. So what does Biden need to go to jail for? I didn't say anything about Biden going to jail. I was answering a question. What does he need to go to jail for? I don't think Biden's going to jail, but I think his son should already have been put in jail. I don't know. We're not getting political. I was answering a question somebody put up and see how everybody goes. Oh, here we go. No, Trump is innocent. Okay. Nobody's talking about Trump or Biden. You guys stop. Let's get back to the facts and let's talk about the news. The reason I just mentioned Biden is because somebody asked a question of who we were talking about. We're talking about Sam Bankman-Fried, not Biden, not Trump. Get your head out of the fucking gutter, people. It's such a divided country. It's, red or blue, Biden or Trump. Fuck it. Let's just make it about us. Let's make it about what we have to do. We, the people, what we have to do to actually get ahead. Isn't that more important than worrying about something you have no control over? Yeah. All right. So there we go, you bunch of jackasses. All right.
Well, while we're talking politics, can we talk about DeSantis or no? Just kidding. Just joking.
Just kidding. Oh, let's see. If grandma couch is covered in plastic. Oh my God. There's some of the comments coming in today. We got a lively crowd. All right. So let's move this over. Let's talk about something that's actually going to be pretty important and that we all really need to focus on. Stephen, let's talk a little bit about Jerome Powell and the Fed. The Fed this afternoon is going to announce yet another interest rate. Now, they just had their meeting. So Wall Street is expecting a 50 basis point increase. Okay. 50 basis points is 0.5%. That's how much they're expecting interest rates going up this particular increase. The next one, I believe, is in February. Now, the last few have been 75 basis points. So now, because of a letter from Congress, it was sent to the Fed and some other things and because inflation, they were anticipating it being at 7.3, it's down to 7.1, which shows that we're moving the right direction from the inflation. But let's not forget the target for the Fed is 2%, not 7.1, 2. So do the math. 7.1 minus 2 is what? It's a long ways. And it's a long ways and a lot of pain to get to there. So I was reading an article from a family office that we do work with. Yeah, Stephen, actually, before I get into the family office newsletter, talk a little bit about consumer prices.
Yeah, so just to hit on the CPI, just give an update. It just came out. They released the November numbers yesterday on on December 13th. So consumer prices rose less than expected. They were expecting 7.3% in November, but they came in at 7.1%, so slightly better. But like you said, compared to the goal of 2%, we're still very high. But so it rose just 0.1% from the previous month and increased 7.1 from a year ago. Compared with respective estimates of 0.3 and 7.3. Core CPI rose 0.2% on the month and 6% on an annual basis. And core CPI just excludes some of the volatility like energy and food. Stocks roared higher following the report as investors look for signs that runaway inflation is ebbing. Inflation adjusted average hourly earnings for workers rose 0.5% for the month, though they were still down 1.9% from a year ago. And then we just get into a little bit of the data, what that looks like since January of 2020. So you can see before COVID, they were right around that 2% mark they aimed for. COVID came and threw a wrench into the entire economy and the world and everything. And then from there, with all the supply chain issues and the printing of more money than ever been created in the history of this country and spending of trillions and trillions and trillions of dollars, it just drove inflation into record 40-year plus highs. We peaked out over the summer and starting to see a little pullback, but as you can see, it's a long way to go to get back down to this 2% where the goal is. And, they control this through raising interest rates. And that's what we were just talking about with the announcement today of what Powell's going to do with the Fed. And we'll see, but they got to keep raising this thing to get those rates down. And that's really hurting a lot of the markets in the economy right now. So it's that balancing act, and we'll see where we land.
Yeah, on Instagram, I'm not going to read it because I don't want to, but Internet Captain, I agree. I don't know why anyone would do that. I really don't. So most of you don't even know what he's saying, and I'm not going to comment on it because somebody just said, well, then don't answer the question, because we got a bunch of softies on here, a bunch of weak folks on here that just can't handle the truth sometimes. But Master Bathing Bear, which is kind of a cool name on TikTok, came in and said, hi, and this is interesting. This is going to go against what you all probably think. High interest rates are better for the consumers. So think about that real quick. High interest rates, are they better or worse for you, right? Like when you think about that statement, because there's a hidden message in there. Most of you, right out of the hole, see, we've gotten so accustomed to this low interest rate cycle. And we've been in this low interest rate cycle all the way. Well, hell, you can go back to the dot-com crash, or you could just take it from 2008, the Great Recession. We've been in this ultra low interest rate cycle, stimulated with a whole bunch of monetary stimulus in terms of, stimulus checks and money printing and, everything you guys have already witnessed. So when interest rates start to go up, we feel the pinch. We feel the pinch on things like our credit cards. We feel the pinch on things like our home equity lines of credit or our lines of credit. We feel the pinch when we go to try to buy a new car and we thought the interest rate was going to be 3 and it's 7. Or when we go to buy a house and the interest rate isn't 2.5 or 3%, it's 6.5 to 7%. So when we think about that, we think bad, but you're missing the silver lining here. And I want to get to this. And Master Bathing Bear, I'd like to hear a little bit more about what you're thinking here. It is actually really good for the consumer, because a low interest rate cycle means there's no safe place for your money to earn a decent interest rate. Think about that. So in the low interest rate cycle we've been in, keeping money in money markets or CDs, not that CDs are a good place to keep money, but I'm just calling out the obvious. Like none of that made any sense. So where did people put their money? Risky assets, Wall Street, okay, real estate, and all of those places where low interest rates drove money, because people aren't going to park their money in safe assets when interest rates are really low, because you're not being paid for putting the money there. So you seek high risk assets. And then what happened is, in the longest bull run in history, which is what we're coming out of right now, the longest in history, you get so used to everything you put your money in making money. I put my money in stocks. I mean, look at crypto, for example. It's a great topic because of what we opened up with. How many people thought they were going to become multimillionaires from crypto? How many people became multimillionaires, started living that rich lifestyle, buying Lambos, wearing Gucci and Prada, and now all of a sudden, where are they? Broke as a joke because they put all their money in an asset class that was in a bubble, and now that bubble has popped in crypto 100%. Now, will it have more bubbles? Sure. Just like everything else. But you see, the thing that we've gotten used to is we've gotten used to unrealistic returns. And one of the laws of wealth, the fourth law of wealth, states if you seek unrealistic returns, your money will flee you. Is that not the truth? We're all witnessing that happen right now. People that are seeking unrealistic returns in Wall Street, in crypto, in real estate, now they're witnessing the other side, the ugly side of that. And their money is basically fleeing them. Some of their money is fleeing them slowly, like in real estate, as the prices start to depress and start to deflate. Many of them in Wall Street with their 401ks and their stock accounts, they're witnessing between a 15 and a 30% drop in value. And that we haven't even seen the fireworks start yet. Like maybe somebody accidentally lit a couple fuses and that's all you've seen with that party. And crypto, you've seen a lot of people become millionaires and become broke all in the same month. But that's exactly what happens when you seek unrealistic returns. So back to what Master Bathing Bear is talking about, high interest rates or higher interest rates. We are not in a high interest rate cycle right now. Matter of fact, we're barely normal if you really look at history. It is good. You can see your money can sit in safe places earning good rates of return. And you hear us always talking about the infinite banking concept and using specially designed and engineered whole life, where that gets you between 5 and 6%. Like that's a great return. But see, what's good about a 5 or 6% return is it's guaranteed. And for the first time in well over a decade, I can tell you a whole bunch of places where you can put your money guaranteed earning a good rate of return, a decent, fair rate of return. Depends on what you measure against. Some of you are like, well, that's not a good return measured up against 7.1 in inflation. Yeah, but how fast is the Fed going to bring inflation down to their target of 2? Is it going to be another 6 months, maybe another year? So when you really think about it, so many people, many of you, okay, especially many of you, based on some of the comments that came in, the second that somebody asked me, who we were talking about, was it Biden going to jail? And then all of a sudden they answered that. And then all of a sudden we had a bunch of vicious, weak monsters coming out of the woodwork. But really, like, those are the people that were seeking the returns, probably. Yeah, I don't mean to call it out, but you really got to look at it. Like right now, things are normal. This is pretty normal for what, if you look at history. And for the first time in a long time, you can actually put your money in safe places, earn a decent return. Stop trying to fix short-term problems. This is for a select couple of you TikTokers out here. Stop trying to fix short-term problems with long-term solutions. It never ends well, okay? When you've got a short-term problem, fix it with a short-term solution. When you got a long-term problem, then you fix it with a long-term solution. But you see, folks, so many folks got it all ass backwards, and they're fixing short-term problems. Inflation, a short-term problem right now. It really is. You might be looking at it because the news wants you to look at it, you dumbass. Shut the news off. And then inflation isn't really as big of a concern. Sure, when you go to the grocery store, it sucks. And when you fuel your car up, it sucks. It's a temporary problem. And well, some of it's temporary. Some of it's here to stay. Get used to it. Get used to it. Your increase that you got in your wages, that's here to stay. Because wages aren't going to go down. Many of you will lose your job. Sorry to give you the bad news. Many of you will be laid off inside the next 6 months to a year. That's a fact. So when you get laid off, the thing that's going to happen is it's not so much that wages are going to change. There's just not going to be as many job opportunities. So many of the people, as you heard, in the upper tech space has got laid off. Lots of people got laid off in the tech space because they hired so many people during the pandemic because their need. And look at Amazon, and now they got to lay people off. We're not even back to the pre-pandemic levels, for jobs right now. So that's a good thing, but it's a temporary thing. We are going to basically have higher unemployment numbers. Mark my word. The Fed knows this. Jerome Powell knows this. They know the only way they're going to get inflation where it needs to be, their target of 2, if that's what they're still shooting for in a year or 6 months. In order to do that, they gotta break the employment market. They do. Because if everybody's employed and everybody's making good wages, you know what's going to happen? Everybody's going to continue to spend, which means it's going to be hard for the Fed to get to the target inflation in the time frame they want. So what are they going to do? everything they have to break the labor market, to break not the labor market, but the employment market. And they will. We'll just call it break the economy. So, Master, Bathing Bear is actually right. It is good for consumers, but you got to stop looking at the negative and start looking at the positive. Too many people focus just on the negative. And if that's all you do is focus on the negative, guess what your life's going to be? One negative bastard. Start focusing on the positive and things change. High interest rates can be good if you know how to play the game. And that's what we teach every single week. This Wednesday, we're going to be teaching that. We got Joseph coming on for Wealth Webinar. We're going to be teaching all about HELOCs, home equity lines of credit, how to leverage them, how to use them. Because pretty soon your home equity, your equity in your house is going to be gone. Because as house prices, and I just saw an article the other day. It showed the stats of all the different states that had high appreciating real estate and how much they're falling. We're double digits right now, folks. Real estate in certain parts of the country, like San Francisco, Salt Lake City, Colorado, double-digit decreases. Double-digit decreases. The demand is still there because there's not a lot of supply, but demand and supply won't play a factor in when people can't afford them. And if the Fed keeps raising interest rates, slow or fast, rip the Band-Aid off slow or rip it off fast, however they decide to do it, I think they should do it fast. I think Jerome and the Fed should raise interest rates 75 basis points. Listen, if we're going to get to what you guys want to get to, let's get there quick. It's going to suck. We're all going to feel the pinch, but let's just get this shit over with, right? No, because that's not good for elections. That's not good for votes. And I don't give a fuck who you're voting for, left or right. Excuse my language. I'm so sick of this shit. It doesn't matter. It doesn't matter what side you're voting on. Both sides are playing the same game. Both sides want certain things to happen so that it's good for their votes. Stephen, what do you have to say about that?
I don't think I could say it any better. So we might leave it at that. But it does bring up an interesting point. I mean, with some of the talk of what the Fed is expecting to do, and it's just pretty bizarre to me how. Let me just share this real fast. I'll show you exactly what I'm talking about.
I love
It's just bizarre to me how like the Fed and Powell, like, everyone knows what's going to happen. In addition to an expected 0.5 point increase, this is what gets me. Investors will be watching how the central bank communicates its future intentions. So just the way that they act will drive markets one way or the other. And again, I'm no masters of, the stock market and economics and like a lot of these very, very smart people. But to me, I don't think the markets were meant where one person says something a certain way and it completely drives everyone's retirement accounts and net worth and everything with just a few words. That just seems broken to me. The whole system just seems really broken, Chris. It's just odd to me.
The whole system is broken. The fact that the markets are where they are right now blows my mind. I mean,
look at this. Call it a sign of the times where a 0.5% increase from the Federal Reserve is considered looser monetary policy. I mean, just to put this in perspective, prior to this year, the Fed hadn't boosted benchmark borrowing rates by more than 0.25 point at a time for 22 years. This year alone, they jacked them up 0.75 point 4 times, plus this 0.5 point increase that's expected today. I mean, that's wild stuff right there.
That is wild. Internet Captain from Instagram came in and said, cash is a bad investment in inflationary times. Cash really isn't an investment in a roundabout kind of way, but you're right. Like in inflationary times, holding lots of cash hurts you because your cash is the buying power. Let me rephrase that. The buying power of your cash is diminished by the inflation. But cash is also the one thing that you're going to need to take advantage of the downside or the opportunities presented from the downside of a recession. So you can really weigh it out. I agree if, again, this is where we get into short-term and long-term problems, right? So inflation is and always really has been a short-term problem. And when I say short-term, a year or 2 years max. So a year or 2 years. So I want you to put this into perspective. Holding cash, okay? Let's just say, and this is for Internet Captain, but this is the easiest way I can sum this up. Let's just say at the beginning of this, let's go back to July when inflation was over 9%. You had cash. The buying power of the cash you had had decreased, had been diminished by roughly 9%. So for the same dollar or for the dollars you're holding, the cash you're holding, you could buy 9% less, essentially, is what they're saying, because your dollars lost value. But today we're at 7.1. Okay. So if you held cash, Okay, that bad investment, as you're saying, you held cash for a period of, let's just say 2 years. Let's say it takes 2 years from last July till whatever. We'll just go 2 years. And you lost buying power of, let's average it out at 7%. Okay, so you lost 7%. Let's just assume that. Now, is a 7% loss on an investment bad? Of course it is. Any loss on investments is bad. But now let's parlay that over to the alternatives and what so many of the gurus said was the thing to do. A lot of them were saying when inflation was running hot, buy assets, go out there and buy stocks, right? Go out there and buy crypto was a lot of the gurus on TikTok saying. How would you be feeling right now if instead of having cash that lost roughly an average of 7%, you put that money in stocks? Where would you be? Well, it depends. Depends on your portfolio, but anywhere between 15 and 30% down. Now, if you were 30% down in your stock portfolio, would you prefer to be in cash at a loss of 7? I sure the hell hope you say yes. Okay. If you were in crypto and you bought in when everybody else was between 40 and 60 because, oh my God, it's going to the moon. And now you're at, I don't even know where it is today, 17, 18, it hasn't really changed. Are you thinking that 7% loss of purchasing power on your cash is a bad investment? No, you're thinking you are freaking the almighty, the most smartest person in the room because you kept your cash. When everybody else told you cash is trash, cash is a bad place to keep your money, it's losing to inflation. What? Even if we went to 9% that you were losing to inflation, is that better than the outcome that you got right now with the stock market? And then we're going to get those people that come in and say, yeah, but if you hold the stocks for the long run, you're going to be doing well. I'll call your bluff because you don't understand the drawdown effect. So here, let's play two sides of that. One person took all their cash and bought stocks. They're down, let's just go 20%. They're down 20% and they're going to go lower, but they're in for the long haul. Oh, I'm going to hold this for the long haul. I'm going to be fine. Great. If you lose let's see what the number. If you lose 30% in a stock, it takes 43% to get back the 30 you lost. So you got to understand the drawdown effect. Where then me, the other side of the coin, I held cash. I didn't buy stocks. I didn't listen to you say, oh my God, cash is trash. Cash is a bad investment. I held cash. And right now, let's just assume right now, I go in and I buy the same damn stocks that you own that you're down 20 or 30% on. Who's better off? I just bought the stocks 30% off. You lost 30%. Who's the winner in that equation? I don't know. I think you can all do that logically and make sense of that. See, there's always 2 opinions, 3 opinions, 4 opinions on everything. Anyone else's opinion doesn't mean anything for your life, folks. Here's the best advice I can give you. Stop listening to people. Stop listening to people tell you what to do with your money. Become a good steward of your own money. Become someone that understands your own needs and goals, and then make decisions with your money based on your needs and goals. Not some jackass that you met at the coffee shop, not some dipshit on TikTok that said, oh, cash is trash. Make your own fucking decisions and you'll be a lot better off. Stop listening to people because they're going to walk you right off the edge of a cliff, just like they've done so many other times. And you know who I'm talking about? I hate to say it, a lot of the financial advisors out there, the people like I used to be. 16 years, I walked people off a cliff. I almost like to say, Stephen, sometimes in that world, what we were is professional cliff walkers. We walked the edge of the cliff and a lot of people fell off and I'm like, oh, well, we still got paid. Anyway, I didn't mean to beat you up there, Internet Captain. I appreciate your comment, but like you got to look at things from 2 different sides. I mean, if that doesn't make logical sense, well, then I guess I'm just the stupid one here. I'm just seeing if anyone commented on that. All right, here we are. We still got people talking about Democrats and Republicans. Let's see. If you owned cars and real estate, you had better than cash. Mike Matthews, please explain that. If you owned cars or real estate, you were better off than cash.
That's true.
What's that, Stephen?
I said that's true. I mean, cars appreciated over the last 2 years. Real estate definitely.
You would have had to sold the car,
right?
And you would have had to sold the real estate, and that's the problem. Most people don't ever get off the train; they buy the asset. So I guess like that's cool, Stephen. You could make 2 sides to what Mike said. Would it have been better to buy a car or real estate during, the time when we were hyperinflation last July? Yeah, it would have. But you would have had to have then sold the asset, sold the car, and sold the real estate to benefit from that. Because if you held the car right now, cars are starting to lose value very quickly. I just was looking at Porsches the other day because I'm infatuated with the Porsche 993 Turbo S. If any of you have one, please contact me. And I'm not going to pay top dollar for it, but a 993 Turbo S. All Porsches have lost tremendous amounts of value, with the exception of a couple rare ones. And that's because they were appreciated so much. So you always have to remember, buy low, sell high, and don't lose money. Too many people buy, but they never sell, and then they ride the next roller coaster down. And when it loses value, then they're like, "Oh my God, I got to get rid of this before it loses anymore." That's the emotional, the psychology that plays into why investors make so many mistakes. It really is. And I love what Ocean888 said here on YouTube. He said, "Cash," and I'll put it up. Actually, you just had it up. It's awesome. Cash is simply a tool of work. Do you prefer to work for it, or do you want it to work for you? That's very smart. Very smart. Very, very, very good way of saying that. So, Stephen, what else is in the news that we can talk about? I know I went on my little rant, but I think I do that every week.
So there's a breakthrough in nuclear fusion.
I know, that's crazy.
Which it goes to, I mean, here, I'll read this, but it goes to show you that we have, there's so much talk of global warming and we got to stop gas vehicles, even though the people saying this are flying around in their private jets around the world. And it's just also silly. And then you look at what the other countries are doing, places like China and India that just don't give a shit about any of it and are polluting more than we ever. I mean, it's insane. So the whole thing. But at the end of the day, what's going to save us, that always saves us, is technology and breakthroughs. And, we lean so much right now on these batteries. And when you look into actually the environmental effects of mining those batteries and then the disposal of those batteries and solar panels and the rest of it, it's environmentally, arguably worse, Chris. We've talked about this, right? And so it's things like this, though, that make you say, stop the panic. This is all just nonsense. Let science take its course. Let the human mind do its thing and create and build. We talk about that all the time, Chris. How do you become successful? You don't conform, you create, right? And that's what this is all about. And that's what's going on right now. So you look at right here, U.S. officials announced nuclear fusion breakthrough. And so what they said is that U.S. scientists for the first time have successfully produced more energy from a nuclear fusion experiment than the laser energy used to power it. So the amount of power it takes to create this nuclear fusion is generating more power now that can actually be used. And supposedly it's very, very clean, zero emissions. And this is a big deal.
If I'm not mistaken, I don't know, I'm not a fusion expert, but we've all learned about it in school and we read about it. And we always thought it was like, that's never going to happen. But fusion exists in nature, and it is one of probably the most efficient power sources ever, if we could figure it out. Now, that we might not fully figure it out in my lifetime. I'm 45. I don't think I'll see that fully figured out, but it's really cool to see that they finally have found a way that the energy in, it's producing more than what it took, energy in. They're getting more out of it. That's
it's really fascinating. What is nuclear fusion and why does it matter? Nuclear fusion is a man-made process that replicates the same energy that powers the sun. Nuclear fusion happens when two or more atoms are fused into one larger one, a process that generates a massive amount of energy as heat. Scientists around the world have been studying nuclear fusion for decades, hoping to recreate it as a new source that provides limitless carbon-free energy without the nuclear waste created by current nuclear reactors, which, by the way, the person that was in charge of the United States federal government for disposing nuclear waste was also fired this week, rightfully so. I'm not sure if you followed that story, but
I didn't. The heads are rolling. Here's two things I like. Let's see who said this one here. This is actually a really smart one. Tomcat with a lot of ones on TikTok said, debt was an asset for a while, but we are currently in an area where cash is king now. It's a revolving door. And he's absolutely correct. Depending on different economic cycles, there's going to be different things that make sense. Cash is trash. That was one economic cycle, a short-term one. And then debt was good. Debt will probably always be good if you know how to use it and it's good debt. But you're right. Like the debt that we used for, the debt we use to buy assets right now is actually going to be a problem for a lot of people because the amount of debt they hold on the asset is going to be more than what the asset's worth coming to a theater near you. So cash right now would be king, or the liquidity of assets or the liquidity of cash or money, such like, what we do with the specially designed whole lives, like that's liquid money that is guaranteed and we can use at any time. So we'll be able to take advantage of opportunities. So I love that. 2J Dub said you should be a super CFP. I don't think I'll ever be a CFP, but a super fiduciary for sure. So hey, let me give you a prophecy, not a prophecy, but just a vision of mine. Okay. I dream a lot. So you folks can all take this for what it's worth, but let me tell you what's broken in the financial advisory world. What's broken in the advisory world is that advisors have forgotten what their job is. I know I did when I was an advisor. I didn't forget. I just didn't know because I wasn't taught what my job was. As an advisor, I was taught to sell a product, just like Stephen. He worked for Ameriprise, right? Ameriprise Financial?
Correct, yes.
They were really sought after advisors for Ameriprise back in the day. But we were all told and taught and trained to sell a product. Now, selling a product sometimes can be a good and bad thing. But in the capacity of the financial advisor or the financial services professional, they're selling a product so that they get paid a commission. And a lot of times the commission is the driving force to why an advisor suggests or recommends a product. Now, most financial advisors, okay, not all, but most financial advisors and all financial services professionals, Series 663, okay, not Series 7 stockbroker licensed, okay, all of them, one thing that they are not is a fiduciary. A fiduciary's role is a role where you serve the best interest of your clients, first and foremost. You are a fiduciary of your client's wishes or client's assets or whatever the clients tell you that they want. You become their fiduciary, which means you need to act in the best interest of your client's needs and goals. Now, doesn't that sound right? That sounds absolutely right. That sounds like, oh my God, well, that's what every advisor should be, but they are not. Most financial advisors, especially ones that are selling products, they are not fiduciaries. Look it up. They are not. Now, when you get into the higher echelons of advisors, they are called IAs, investment advisors, or typically they would work for an RIA, a registered investment advisor. This is what I did in the last several years of my career. Okay. RIAs, if they're not associated with a broker dealer, this is where it gets complex. You'd have to read the fine type on the back of the business card or website. An RIA, a true RIA, all IAs that are part of an RIA are fiduciaries. Okay. By law, they have to serve the fiduciary responsibility. And if they don't, they can lose their license. They can get fined. They can be put through arbitration. They're a fiduciary for their clients. That is the right capacity. But there's still a lot of skewing in the RIA world, the registered investment advisor world, as you get kind of into the middle advisor pool, because most of these RIAs are associated with a broker dealer. Broker dealer gives that RIA or the investment advisor, IA stands for investment advisor, gives that investment advisor the ability to sell a product through the broker dealer. Now you're getting paid a commission again. But if we just got rid of the broker dealer, we just got rid of the ability to sell commissionable products, and the investment advisor's sole capacity was just to provide sound advice, sound consultations, sound direction to their clients as a fiduciary without ever having to sell a product. They get paid like an attorney does, because an attorney is also a fiduciary. They have to act in your best interest. They get paid a retainer. Maybe you pay them $100 a month. Maybe it's $500 a month. Maybe you pay $1,000 a month retainer to have an investment advisor give you the advice based on what you decide. What you, as the individual, you, the person that makes the money, you, the person that has the money, what you decide you want to invest in. Let's say you're looking at a real estate syndication deal, just as an example, and you don't know how to read the syndication documents. You don't know how to read the PPM and the subscription agreement, but you've got an IA who you've retained, or maybe you just go out and you retain one, or maybe you just pay them just to review this. The IA reviews this, but the IA first has to know your needs and goals. And then they say, well, I think that this syndication is a bad, it does not fit your needs and goals, and I would not recommend or suggest this. Maybe the IA even does a research report for you showing why it's not a good investment for your needs and goals. Then if you decide to buy into the syndication, it was against what the IA said, but at least the IA gave you advice based on a fiduciary capacity. Think about that. Wouldn't that be great if all financial advisors and all investment advisors out there acted in that capacity, where they were just there to give you sound advice without any commission driving their decision as to why you should buy this or invest in that? Wouldn't it be really freaking, it seems like it would level the playing field. So here's my vision. I intend to change that. I intend to be the person that helps pave the way for that new IA model, that new investment advisor where you are just paying for the service. I like to call it hand-holding, or a concierge for you, or just somebody that's got your back. And all you do is you just pay, based on your level of need, you pay a specific monthly retainer. Okay. You retain an investment advisor that is not associated with a broker dealer, that is there just to provide consultation and advice, nothing else. If you decide you want that IA to manage your money, that's because you decided it, not because that IA suggested, oh, well, we should roll this money over to our platform and we should then put that money in the funds that we manage. No. You decide. You see, because now you're in control of your money. Now you're in control of your decisions, but now you've got a professional that is by capacity and by license, somebody that knows how to give you advice or get the advice that you need to make sound decisions. Sorry I went long on that, but that's what's broken. And that's what needs to be fixed. You will never, ever not probably in our lifetime, you will never probably have advisors that don't sell products because there's too much money in lobbying. And when they lobby, oh, we're going to take, and they've tried taking this away. They've tried making all financial advisors fiduciaries. They succeeded in some capacities with ERISA and some of the stuff with 401ks, but they haven't succeeded and they probably never will because of lobbying. So I don't know what you all think, but I love that 2J Dub just brought that up and I just wanted to put that in. I know I went long on that, but what do you all think? Do you think that that would be a better use of an investment advisor? Do you think that would serve you better? Do you think that would be a better path for most people based on their needs and goals? I can tell you it would for millennials. It certainly would, because it would teach millennials to be good stewards of their own money. It would teach them to be in control of their money, but then they'd have the advice and the knowledge of somebody that actually knows how to read these complicated PPMs, private party memorandums, and subscription agreements and prospectuses and all these things that most people, the average public, does not know how to read. Look at that. A bunch of people are saying, absolutely, absolutely. Thanks for having our back. Yeah, I mean, of course it is. So why don't we seek those kind of advisors? Well, just stay tuned because that's coming soon. It's coming soon right here because we are doing that now. We are putting the foundation down for paving this way. I'm going to be one of the most hated men to financial advisors because I am literally going to be the guy that financial advisors say, oh, that Chris Naugle guy, I hate him. You know why they hate me? I'm taking money from their pocket and giving it back to you, the person that deserves it, the client. So, hey, if I get a lot of hate now, I've just been in training, like Rocky Balboa in Rocky 2 or Rocky 3 or any of the Rockies you want to watch where he's training. I've been training. All the hate that I've been given, all the hate me and Stephen have been given, just think of the Rocky scenes where he's like in that training mode and you hear that music. We should play that music. That's been us. We've just been preparing for more hate so that we know how to handle it. So bring the hate on, folks. We love it.
Bum, 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 bum. I don't think we can play it, but I love it.
Yeah, we can't play it because it's
ready to run up and down the stairs in Philly,
Why are two people talking? I don't know. Why are you here? Let's see. People spend thousands of dollars and free information, but they won't spend money for the advisor. You're right, Tom. Tomcat 111, right? People love free trainings, and you know why they love free trainings? Because they don't pay any money for it and they never do anything with that knowledge. But people, when they pay for something, they are more likely, it's been proven fact, they're more likely to apply that knowledge in their life and actually get results from that because they paid for it. I don't care if it's $10, $20, whatever it is. When you pay for something, you value it more. It's stupid, but that's just what it is. But hey, our training that we do this afternoon at 1 p.m. Eastern, the wealth webinar, is free. So come on, and we'll try to get you to take action on it. What else is in the news outside of the Fed has to portray itself as tough on inflation, even as it pushes through a smaller rate hike? Yeah, 50 basis points, small rate hike, huh? Good job.
I was real fast. I was just reading about SPF, and they said at a hearing yesterday, Mr. Ray, one of his attorneys, affirmed that he would cooperate with prosecutors. He also listed FTX's numerous business failures, including its accounting being run on QuickBooks. So a $40 billion company run on QuickBooks.
I mean, we use QuickBooks here. It's a great software program, but I can't imagine running that would never work. You'd need custom accounting. You'd need accounting teams. You know, FTX probably had like 1 or 2 people in a small little corner office plugging everything into QuickBooks. Oh, that's comical.
I will never forget when FTX bought the naming rights for American Airlines Arena down in Miami. That was American Airlines forever and was a staple. And FTX came in and paid all that money for the naming rights for it. And I just remember talking to people. I'm like, what is FTX and how do they possibly have that much money to do the naming rights? It was like a multi-billion-dollar deal. And now you see it all come out that it was all just fraud. It's just amazing. What a wild story.
Yeah. So here that one person said, I'm trying to understand how everyone can buy low and sell high. Now the second person stopped talking. I don't know who the second person is. There's only me and Steven. Oh, they're on TikTok, Steven. So I'm sorry, folks. TikTok, like we do this show and I don't have a way to plug TikTok into StreamYard. So there's Steven. Steven, say hi.
What's up, TikTok?
There you go. Same thing with Instagram. So unfortunately, technology hasn't caught up to our show yet, but I'm sure it will. So we were talking about buy low and sell high.
Chris, you just killed the camera.
Oh, hang on. I know what I did. I unplugged my camera.
Yeah.
How, I don't know, but that better? No?
Not yet. You probably have to just turn the camera back on StreamYard now.
Oh, sorry, folks. I biffed my camera. No, I don't know what happened. Steven, I lost all cameras. I don't know what happened.
All right.
That's all right. You know, you're a better looking guy than I am, so we'll just leave it at that.
now TikTok and the rest of the group cannot see one of us.
Well, it says that my camera was unplugged, but my camera is indeed plugged in. How it can see that it's unplugged. But if any of you know me, anything I touch with technology usually breaks anyway. So it's I have no idea what the hell's going on. It's plugged in. It's just
we're about to the end of the show anyways. We got a really good show lined up at Wednesday at 1:00 Eastern for you guys though today on banking and tapping into that equity and HELOCs and how all this can work together in some of these different real estate deals and some of the different opportunities that are coming up. So make sure you join us. You can go to chrisnaugle.com and just scroll to Wealth Webinar Wednesday. It's a free webinar. Register. We'll have several hundred people on today, and it'll be a really good show. And Joe is joining us in the studio, right, Chris?
Yes, he is. Yeah.
Yeah. So Joe's earned the nickname of HELOC Joe, and HELOC Joe's got some good stuff prepared. So make sure you join us today at 1 Eastern for the Wealth Webinar series.
I love it. I love it. So back to the buy low, sell high, and don't lose money. That's a Warren Buffett quote. He said that's the best way for anyone to invest money is to buy low. So how do you know when you buy low? You're never going to get the bottom and you're never going to get the top. So get that right out of your head. Ray Dalio can't do it. So what makes you think you or I can? You can't. But what you can do is you can look for opportunities. And opportunities, typically the easiest way to spot them is when everybody's bitching about them, when everybody's crying about them, when you start hearing around the water cooler at the, when you're waiting to use the restroom, or you're just, having one of those conversations at lunch or out for coffee where everybody's complaining, oh my God, the markets are falling apart, I'm losing so much money. You hear it. You just got to listen for it. At that point in time, when you start hearing that, that's a good sign that you're getting to the point where you could buy low. I think it's early right now. A lot of people think right now is the time to buy. I think that's a big mistake because I think the stock market's going to go a lot lower and wait for the next phase. We've had the first dip. So when you look at recessionary periods or any of these economic cycles, usually there's a first dip, which is about a 30% dip. And we hit that. Okay. I can't remember when we hit that. It was midway through the year, actually earlier in the year, we hit that. Then it bounced back. Okay. So it didn't bounce back a lot, but the next phase, the next drop will be the one to probably start looking at buying low. You can just watch real estate. Don't ask realtors. I was at a Christmas party this weekend, and I love her to death. She's my realtor, but I just asked her, I said, so what do you think's going to happen with real estate? Oh, I think it's going to keep going up. Like we just sold a house the other day, 50,000 over ask, and this other one, 100,000 over ask, and blah, blah, blah. And she keeps saying this. And my wife who knows this starts saying, well, wow, Chris, see, the market might keep going up. I said, are you out of your mind? Like real estate's a lagging indicator and it means nothing. So real estate is way too early to start looking at buying low. There's always opportunities in any market at any time, but you got to look really hard. I'm just talking for the masses. If you were looking for a buying opportunity, when there's blood in the streets, okay, when everybody that you talk to is fearful of the markets and they don't want to invest in the markets, if everybody that you talk to is like, oh, no way I'd ever touch crypto, there's no way I'd ever touch, and crypto is a weird one because there's no intrinsic value, so let's just leave that out. But right now might not be a bad time to buy into Bitcoin. I mean, it wouldn't be the bottom because I think the bottom's around 10,000, but still you'd be buying low compared to where it was. But stocks, when you're talking to people and everybody's saying how they would never invest in stocks, they're never going to invest in stocks again, they've lost almost all their money, guess what? It's pretty low. Maybe a good time to find one or two companies that you love and buy their stocks. And maybe get yourself one of those IAs that doesn't want to sell you a product, that just wants to give you advice and just say, hey, listen, I'm thinking about putting this cash that I've been sitting on into the market, and I love these companies. I know, like, and understand what they do. Can you do some research and tell me whether these would be a good buy right now based on past, the past charts and everything else? And then the IA comes back and says, sure, no problem. It's, $200 or whatever they charge you for their hour of time. And boom, now you got the right decision to make. And some people on here are asking about gold. I don't ever think there's a bad time to buy gold, but don't go crazy and own all gold. Like, I know investors that literally went all in on gold when gold was going up, thinking, oh, this is the way to go. They're underwater right now. So if you're going to buy gold, 10, 15% in precious metals, max of your entire investable assets, that would be it. But buying gold, there's never a bad time. Stephen, do you still do that gold show that you used to do?
We haven't been doing the show just because of some other initiatives we've been doing, Private Money Club, but we plan on getting it started back up at the first of the year.
Okay. And then solid, I can't really read the whole thing. I got my short-term vision's bad. Bitcoin is not part of the ISO. I think that's supposed to say 2022. Borrow from your policy and buy stocks and crypto. There we go. So that's somebody that's been around the campfire talking a little bit about infinite banking concept, the process, and what you do with that. Love it. And we're going to be talking about a lot more of this stuff this afternoon at 1 p.m. But specifically, we're going to be talking about something you all need to learn about. And that is, what the hell should you be doing with the equity in your house? And is the equity in your house that you have right now in danger of disappearing? And the answer, well, you should join us at 1 p.m. Eastern by going to Chris Naugle. It's Naugle. Go to chrisnaugle.com, a couple index fingers, and sign up for the Wealth webinar. It is free. We'll even give you my 3 books for free. And all you do is just show up at 1 p.m. Eastern. If you can't make it today at 1 p.m. Eastern, if you're registered for it, we do record it, and you will get copies of the recordings once they're edited. Stephen, what else you got before we close this show up?
JP was just saying, what's an IA? It's an investment advisor, JP.
Yeah, very different than a financial advisor.
Mm-hmm. That's about it, Chris. We, if anybody's looking, I have a couple real estate lending experts ready to do demos for Private Money Club. So just reach out to us if you'd like to get a demo and learn a little bit more about Private Money Club and if it can solve your problems. If you're looking to keep money moving and you're weary of the stock market and some of these other, possible lending on real estate deals where your money's protected by the land, by the house, by the asset, that could be a good solution for you to keep that money moving. And if you're actively in real estate, you're working, you're growing your portfolio, you're new, you're looking to get into the business, you just need money's holding you back, a great solution could be Private Money Club. So definitely check out privatemoneyclub.com and let us know if you'd like to get on a demo with one of my experts. They're standing by waiting for you. But awesome. Other than that, join us at 1 p.m. Eastern today to get in deeper about all of that.
And before we close up, on Instagram, we got one person coming in asking a bunch of questions. How do I ask questions? You're doing it right there. I would have saw those. You're just coming in a little bit late because we're finishing the show up in less than 1 minute. But you can join us this afternoon at 1 p.m. for the Wealth webinar, which is a free training we do every single Wednesday at 1 p.m. So how do you register? Great question. I'm glad you asked. You just go to Chris Naugle, Naugle.com. 2 index finger swipes on the main page. You'll see it. Wealth webinar. Sign up right there, and then you can join us for that. And inflation will get interesting when it gets so high we need a wheelbarrow full of cash to buy a candy bar. Oh, he's talking about good old Germany that was really what they did. They had the marks and they had to wheel them in I think it was the marks. They had to wheel them in a wheelbarrow just to buy a loaf of bread. Could we get there in the United States? Yes, we could. Will it be in our lifetime? Probably not, but hey, nothing's off the chopping block right now. So great questions. Thank you all for joining us for another edition of the Wealth webinar, and we do this every Wednesday at 1 p.m. So make sure you tell your friends, tell all your people on social media to join us here where we rant, we rave, and yes, we will argue all about the news in the prior week. Till next time, we'll see you then.